Rebalancing a portfolio is just the process of realigning all of the assets and various holdings that you have to return to a desired allocation. To give a very basic example, let's say you have a long-term buy and hold portfolio that's targeting 50% stocks, 25% bonds, and 25% gold. Over time, as those assets gain and lose value, your original portfolio allocation is going to change. If stocks go on a good run and maybe gold underperforms, your original allocation might turn into 60% stocks and only 15% gold. This means you're now too heavily weighted to the stock market and your gold holdings are underrepresented compared to what you originally wanted. So you have to go through the process of rebalancing. In this simple example, you just sell 10% of your stock holdings, put that towards adding to your gold holdings, and that'll bring you back to the original 50, 25, 25. Through this rebalancing, you've reduced your exposure to the stock market, and you've also dollar cost averaged your gold holdings. Now, there's two basic ways to trigger this rebalancing. The first is you could do it based on a time schedule, so you might decide maybe once every 6 months or once per year. The second is to rebalance whenever things move further than a set threshold. So you may decide if assets move more than 10%, either up or down, that's going to trigger the rebalancing. Both methods are effective and you can even combine them both. It's really just important to be consistent over time. Rebalancing effectively maintains your investment goals, it forces discipline on your trading decisions, and it also reduces risk and improves performance in the long run. So it's definitely an important part of the investing process. Now let me get into the question that actually prompted this video. Do you rebalance the 50% ETFs, 25% condors, 25% volatility after each trade, quarterly or annually? So great question. Let's talk about how all this applies to us and specifically our total portfolio solution. So I'm not a buy and hold investor. I trade tactically, which means that I'm only ever holding one single position within any single trading strategy. For example, my tactical balance strategy doesn't hold stocks, bonds, and gold all at the same time like a traditional portfolio would. Instead, based on current market conditions, we will only ever hold one of those positions. So it'll either be stocks, bonds, or gold, but never more than one. The tactical volatility strategy is the same. It'll only ever hold one position at any one time. And the total portfolio solution is allocated like this, with 50% balanced, 25% to the derivative strategy, which is iron condors, and 25% to trading volatility products. Just like with traditional investing, we don't want to get into a situation where our allocations are misaligned. And you'd think that this would happen because all of our strategies have long-term performance results that are actually quite different from each other. Our core balance strategy is the most conservative with a long-term 14% annual return. The iron condor strategy is right in the middle with a 23% annual return. And our higher growth volatility strategy has achieved over 80% a year. So given enough time, you'd think that our portfolio would deviate quite substantially from our original target allocation. But the good news for us is that rebalancing actually happens naturally as we're taking on new trades. If you're a subscriber of mine, your original allocation will look something like this. Over time, your portfolio value will grow, but because we're not buy and hold investors, every time a new trade needs to be taken, you're just going to be buying based on these allocations. All brokerage accounts are going to show your daily total portfolio value, and they'll probably call it your net liquidation value. Any new trades entered, you just buy based on the allocations. If, for example, a new volatility trade is required, you're just going to buy 25% of your fund value in shares in the XIV. And to make things even easier these days, most trading platforms actually allow you to buy percentages of your net liquidation value. So in this case, you can actually just input 25% of your total fund value, and it's going to buy the right number of shares for you. The actual dollar value of your trades is going to be going up over time as your fund value grows, but those allocations are always going to remain the same. So not only is trading tactically far superior in terms of performance as well as risk management, but it's also a whole lot easier to manage over time because that important aspect of portfolio rebalancing, it just happens naturally as we go. Now, there is a situation where this wouldn't be the case, and that's if you have all of your funds and all of your money separated over multiple trading accounts. Now, of course, it's in everyone's best interest to simplify those accounts as much as possible. If you could put it all in one place, that would be ideal because you can cut down on trade fees and transaction costs. But for a few of you, that's just not going to be possible. So if you're in that situation, I'd recommend just making things really simple and rebalancing once per year. In January, you're just going to allocate a certain amount of capital to each of the strategies, trade them independently of one another as the year goes on, and then in December, you're just going to rebalance back to the original target allocation. Portfolio rebalancing is important, but fortunately, like I said, in our case, for most of you, it's just going to happen naturally on its own. If you do need some help though, by all means, just email me, and I'd be more than happy to go through your specific situation with you. So thanks for watching. So if you go ahead and click the link right here, sign up for the VTS Newsletter, you're going to get complete access to all of our trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Hit that like button for me, it'll help me grow. And also leave a comment, I'd love to hear from you. See you next time.